Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement Podcast. Well, this podcast is a continuation of past discussions we've had, focusing specifically on the retirement planning needs of incorporated professionals. In this podcast, Thomas Holmes and I will discuss legacy issues as it relates to incorporated professionals. You've worked very hard for the assets you've built up. You've developed your retirement game plan. You now know how much in the way of capital and resources you need for your long-term financial security and that of your family. Now you're turning your attention to tax strategies and legacy strategies to protect the hard-earned wealth that you've built up through your company and other financial assets for the next generation, to create legacy both for your family as well as your community. So you'll enjoy this edition of the All Things Retirement Podcast as we unpack legacy planning for incorporated professionals. Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement Podcast. In this edition of the podcast, we're going to talk about a question that really is paramount for those business owners or self-employed incorporated professionals who have done some planning. They may even be in retirement or very close to retirement, and they're wondering how they can accrue future value of all the assets that they've built up, that they've worked hard to build up to future generations. And so joining us on this particular podcast today is Thomas Holmes, CPA, CA, and works with Assante Private Client. Thanks for joining us today, Thomas.
Thanks very much for having me, Shaun.
One of the reasons I wanted to have the conversation with you today on this topic, Thomas, is that a lot of the work that we do for our clients is to, get them ready for retirement and to transition into retirement and have a successful experience around generating the after-tax cash flows they need to maintain their lifestyle through the retirement years. A natural byproduct of those discussions is confirming for them, do they have enough capital to do the things that they need to do between their corporate assets and their retirement accounts, whether it's individual pension plans or retirement income funds or RSPs, tax-free savings accounts, and open money. Once we nail that down and we're really confident that they have sufficient capital, it often turns to the discussion of, this is what you need, but you've got more capital than that. Does it make sense to do some legacy planning or planning around freezing the value of your current estate to reduce tax liabilities and pushing those liabilities into the next generation's hands? And sometimes that's referred to as estate freeze strategies. So maybe you can unpack for us today, how that kind of plays a role in someone's planning, some of the high level criteria for when someone should begin thinking about it, and maybe just a broad overview on some of the kinds of strategies that people typically use around that whole area.
For sure. I think that estate freezes are definitely one of the most widely used tax reorganizations, and they're done for a number of reasons. First and foremost, an estate freeze is a transaction whereby a current shareholder will exchange their common shares, this is a general estate freeze, I should say,
okay.
Exchange their common shares that are currently accruing value and growing with the company for what we'll refer to as fixed value preferred shares. In this situation, those fixed value preferred shares will no longer increase in value. So if the company is worth $1 million, $1 million worth of common shares will be exchanged for $1 million worth of preferred shares. Those are now fixed in value. And now what we do is either the same shareholder or a new group of shareholders will then subscribe for common shares at a nominal value, so that all future growth of that company will go into the hands of the new shareholders. So a common situation would be mom and dad would exchange their shares for fixed value preferred shares at a time when the company's worth $1 million.
Okay.
Kid 1 and Kid 2 will subscribe for new common shares. 5 years from now, the whole value of the company has grown from $1 million to $2 million. Mom and dad's fixed value preferred shares are still worth $1 million combined. Well, each of the new kids have common shares worth $500,000 for a total of $2 million. You had mentioned a few of the reasons in the introduction, but there's a number of reasons why estate freezes are a really smart tool. For a family business, it's the easiest way, or one of the easiest ways to accomplish succession planning.
Okay.
This whole transaction can be done on a tax-deferred basis, which means there's no tax, no initial tax on the transaction. So if you really want to get your one of your children involved in your family business, this is one of the easiest and quickest ways to do it, and no tax implications. It's also a big way to reduce terminal tax. As you said, If somebody feels they have enough, I should say the proper planning has been done to ensure they have enough money and that any gain in the business going forward is wealth that they won't ever need. From a tax perspective, it makes sense to transition some of that wealth into the next generation.
Okay. Here's a question for you. So I'm a business owner or self-employed professional, and I've done the planning, and I feel confident at the time the numbers are right, but we're now five years into the strategy, and I'm feeling a little bit anxious about whether, in fact, I do have enough capital. Some surprise expenses have come up for me, and can I rework that plan? Can I go back to my kids and restructure that freeze? Can I take back? Are there any flexibilities around that?
It depends a lot, and I think what we often will suggest for someone that isn't quite sure, or they feel that there's a chance that they'll want more going forward, I say, that they can freeze their initial shares, and when the new shareholders subscribe for shares, rather than the kids or the spouse or whoever getting 100% of the new common shares, the original business owner would take back some of the common shares as well, so that they can participate in the growth going forward as well.
Okay, so they participate a smaller amount of growth, so you're capping the tax bite a little bit.
Exactly.
But there's no easy strategy between doing it and then still capping all growth and then having a backdoor down the
Yeah, we'll see a lot of in some cases there'll be multiple freezes depending on the situation to make sure until they find that perfect mix. But that would probably be the recommended approach, is to make sure that if you're not 100% certain, or if there's a chance that you'll want some going forward, that you keep a little skin in the game by keeping some of the common shares.
Okay, perfect. That's great advice. I think that one of the key things around this whole topic is just the intentionality of it, trying to build that succession plan, getting the next generation involved. You're not doing it in a terminal estate planning situation where everyone's scrambling at that point to try to figure out what the next steps are. You're there, you're actively engaged in rolling up your sleeves and determining how you're going to shepherd your business to the next generation, which is critical. I know that for your group, the Assante Private Client Group, one of the big areas you work in is that plan, where you start helping clients to confirm, do I have enough?
Yes.
What assumptions should I be using to make sure that my planning is bulletproof, that I can then feel comfortable and confident that I can initiate this estate freeze strategy? That's one of the things that you do, correct?
Absolutely. I think what we realize is that you can't just jump into a situation and figure out and start doing tax planning. You have to take a step back and really figure out what that particular individual or family wants. When we see a lot of plans, the cart is put before the horse. We have to make sure that we know exactly what that business owner wants. In some situations, a person might implement an estate freeze and give 100% of the new shares to their children, without really having that conversation with them to say, listen, your children now own those shares. You no longer hold them. Are you going to be comfortable with that? And business owners that might not be comfortable with that, we might suggest, rather than having the next generation subscribe directly for the shares, we would insert a family trust.
So sort of layer of control then.
Exactly. And so with a family trust, the business owner could be a beneficiary plus the trustee of that trust. Okay. And basically that, like you said, that adds an element of control, so that going forward, even though they don't hold those shares directly anymore, they can still call the shots and decide what happens with them.
That's great advice. And I think the bottom line is, like you said, the planning and making sure that there's good dialogue and communication. It seems to me that this is one of those areas where there needs to be a family discussion on expectations. And I think you hit the nail on the head there where, don't make any assumptions. Your kids may not even want to necessarily participate in these structures, or they have different ideas about how the future might look. And so begin having those conversations.
It's funny when you have these conversations, because often one side, the parents may have made assumptions about what the children want. The children will make assumptions about what the parents want, and both sides are way off. Yeah. And so it's important to make sure that everybody's on the same page to ensure that the family business has a smooth succession.
Great advice, Thomas. Thanks so much today.
Yeah, my pleasure. Thanks, Shaun.
Well, I hope you enjoyed this edition of the podcast, All Things Retirement. I think Thomas did a great job of unpacking the discussion on legacy and tax planning. Well, we've developed a comprehensive retirement planning process that we call Game Plan. And game plan not only helps to confirm if you're on track for retirement, but it also confirms what kind of financial resources will be available for legacy planning. Legacy planning really takes place once you know that your own financial planning and retirement income planning needs are looked after. Once you've nailed down that question, then all kinds of interesting strategies can be introduced to your situation to pass on wealth successfully and tax effectively, not just to your family, but to other legacy priorities that you have. If you'd like more information about the game plan process, be sure to go to our website at www.shaunhumphries.com. As well, there's other helpful free resources on all things retirement, as well as some other wealth planning topics, tips, and strategies. If you want to contact our office directly to talk about the game plan process, our phone number is 204-977-8022. All the best in your retirement planning journey.